Hi everyone, this is question number 18 from chapter 9. Um, so the question asked us to fill in the information and for the market quantity supplied, or in other words, the market supply curve, given some information. And this information is provided in this table. So basically it provides quantities produced by each firm, total fixed cost, and total variable cost, and total cost, average variable cost, average total cost, and marginal cost. So we have 100 firms producing a certain product, and all of them have the same cost schedule. Basically, the cost structure is the same for them. And we assume that in perfect competition because we assume that firms have access to the same technology. In order to answer this question, let me review what we did last time when we discussed the cost structure in perfectly competitive market, or the profit maximizing condition in the perfectly competitive market given a cost structure. So this is the average variable cost. This is the average total cost. And this is the marginal cost curve. Quantity. Now, in the last class, we discussed some profit maximizing conditions, right? So if this is the price, at this price, let's call it P1, this company should produce this quantity. So first of all, let's call it Q1, should produce the quantity. The quantity that maximizes profit is where marginal revenue is equal to marginal cost. In a perfectly competitive market, marginal revenue is equal to the price. It's equal to P1 in this case, right? So in this case, this company will have a positive profit, and it should produce in the long run and in the short run. But we explored like several scenarios. So if the price falls below average total cost, but above average variable cost, again, this company should produce in the short run in order to minimize losses. So this company covers its variable cost and part of average fixed cost, right? So it's running a loss, but it should produce in the short run. So P2, the profit maximizing condition is where price P2 is equal to marginal cost. Now, if the price goes below the shutdown price, this company should produce zero. It should exit the business, shouldn't produce at all, because it will be increasing the amount of losses by production, right? So at this point, the company shouldn't produce this amount. They should just produce zero, because this is a shutdown price. So our goal in to answer this question is, we need to find where the price is equal to marginal cost, is equal to or slightly greater than marginal cost. We might not have them exactly equal to each other, so we have to find a price that is equal or slightly higher than marginal cost, and check whether that price is above or below average total cost. If it's above, this company should produce. in the short run and the long run. If it's below, it should still produce to minimize losses. But it shouldn't produce at all if the price goes below this level. So we need to see whether the price is above or below average variable cost to determine whether the company should produce at all. So the supply curve for any given firm is simply its marginal cost curve that lies above the average variable cost. So this is the supply curve for any given firm. So why the section above the marginal average variable cost? The reason is that below this level, the firm should shut down, should be producing zero quantity. So supply should be zero. So supply starts up from this point. Okay, so this is the supply curve of any firm. So basically, marginal cost tells you what it costs you to produce one additional unit, right? So this is the cost of one additional unit in here. So if you want to produce one more additional unit, this will be the price, meaning that the marginal cost curve gives you the amount of each additional unit produced, or the price of each additional unit produced, basically how much firms will be charging for each additional unit produced in a free market competition. Okay, so let's see the information in this table. Again, our goal is to, first of all, we need to look for the point where marginal revenue, or the price, because the price is equal to marginal revenue in perfectly competitive market, is equal to marginal cost, and then check whether that price is above or below average total cost, whether it's above or below average variable cost, and then determine the quantity from this table. Remember that this is the cost table for a given firm, but we have 100 identical firms. So whatever quantity we get in here, we should multiply that quantity by 100 to get the market quantity supply. So when the price is zero, okay, we don't have here quantity, so we can start with, if we don't have marginal cost, we can start with this quantity. When quantity is equal to, or when the price is equal to 14, the price is still below the marginal cost. When the price is 22, it's still below the marginal cost in here. Okay, so this company should produce zero in here. The reason is zero is below the marginal cost. When the price goes up to 14, marginal cost is 75. So this company should produce zero. So notice that marginal cost decreases at the beginning. Look at this figure, right? So you might argue, okay, but how about like when price is 22? It's is slightly above 20. Should this company produce at all? Answer is no. Why? Because the price is below average variable cost. Remember, we should produce 0 below average variable cost, right? So even though 20 and 10 are below the price, meaning that the price is higher than marginal cost, we shouldn't produce in here because that will be basically increasing your losses. Your losses will be magnified. Therefore, we shouldn't produce in here. We have to compare the price with the average total cost. Now, with this price, 22, again, 22 is above marginal cost and below average variable cost. So it's below the shutdown price. How about 32? 32 is above 30 in here. So in principle, we should produce 6 units. Now we need to check before we do that whether 32 is higher than average variable cost. Yes, average variable cost is 30.83, which means that we are on this section. And therefore, this company should produce 6 units. 6 units, we have 100 companies producing 6 units. 100 multiplied by 6, we get 600. When the price is 44, it's above marginal revenue, slightly above marginal revenue at this quantity, 7 units. Now, let's check, is the price higher than average variable cost? Average variable cost is 32.14. Answer is yes, this company should produce. Will be making losses because the price is below average total cost, which is 39.19. But this company will be minimizing losses by producing 7 units. We have 100 identical companies, 7 multiplied by 100, we get 700. When the price is 52, this will be the profit maximizing quantity because the price is slightly above marginal cost, which is 50. And notice that the price is above both average variable cost and average total cost. So now we are operating at this section of the marginal cost curve. We are above average total cost. So this company will be making a positive profit and it should be producing 8 units. 100 companies should be producing 800 units. Okay, when the price is 62, put it right here so you can see. So 62, this company should be producing 100 companies should be producing 900, and you see that 62 is above both the average total cost and average variable cost. I mean, the tricky section is this section. Why should these companies be producing zeros? So I'm going to write here 900, and finally, when the price is 74, this company should be producing 10. 100 companies should be producing 1,000. And again, you see that 74 is above both average variable cost and average total cost. Okay, so the second section asks us to calculate the equilibrium price in this market. So equilibrium price is the price where market supply is equal to market demand, and market supply is equal to market demand at this price. Let me market. So right here, this will be the equilibrium price, because market supply is equal to market demand only at this price. So price is 51. Okay, the equilibrium market quantity, of course, it's 800. And each firm will produce quantity of, we have 100 firms, each producing 8. So each firm should be producing 8 units. 100 divided by 100 firms, because they have the same cost structure. So at the level of output, each firm will earn profit equal to. So remember that profit is equal to total revenue minus total cost. So we should have total cost from this table, and total revenue, we can calculate it. Total revenue for each firm is the price, which is 51, equilibrium price. So firms are price takers, they just take the market price multiplied by quantity. Profit maximizing quantity minus total cost, we get it from this table. So total cost will be 325 at this level of output. So at this level of output, this will be total cost for 8 minus 325. So 8 multiplied by 5, so 8 multiplied by 51, sorry. So I got here 408. So 408 minus 325 is equal to 83. Let's check. So profit for each firm will be 83. Okay, we are not done yet. So we have this multiple choice question. So your answer characterized the short run market or equilibrium in this market. Do they characterize the long run equilibrium as well? If so, explain why. If not, explain why not. Okay, to answer that question, we will, if the we'll check whether the price is above the average minimum average total cost, right? If the price is above average total cost, profit will be positive, but it will not be sustainable. Will go down because of free competition. We will settle down at this point. If it's actually below average total and above average variable, this company will be making losses, so the price will go up. So the only equilibrium price is where marginal cost and the price is equal to the minimum average total cost. With that said, notice that the price is 51 and the price 51 is above both average variable and average total cost. So we are in here. So this firm would be making positive profit, but in the long run, it cannot sustain it. It's going to lose it because of free competition. Prices will go down. And we know that because price is way higher than average total cost. So let's see what option fits this description. So the short run equilibrium doesn't characterize the long run because the firm earns positive profit in the short run and should shut down. If the company makes a positive profit, it shouldn't shut down in the first place. So it's not A. B, the short run equilibrium doesn't characterize the long run because the firm earns positive economic profit in the short run and should expand in the long run. So the short run equilibrium does characterize the long run equilibrium because the firm earns a positive profit in the short run and should expand in the long run. So this is not bad. Let's leave it aside. Let's see if the other two options are wrong. The short run equilibrium doesn't characterize the long run equilibrium because the firm earns a negative economic profit in the short run and should expand in the long run. So it's not B because at least this firm is not earning a negative profit. And when the firm um, basically um, earns a negative profit, it should produce only in the short run and exit the market, not expand it. D, the short run equilibrium doesn't characterize the long run because the firm earns positive profit in the short run and should expand in the long run. So we are speaking about the long run equilibrium, right? So in the long run, this company should be expanding its capital stock, right? And therefore, this price will no longer be an equilibrium price. So the right answer is D. And the reason is this is the, first of all, is not equilibrium in the short run. Like in the long run, prices will fall right here. But even this price will not be the long run equilibrium price because the company will expand its capital stock and therefore the equilibrium condition will change when we have a new average total cost curve. Remember the long run average total cost curve is a U shape that includes all the short run average total cost curves. Okay, thanks for watching.